JPMorgan is out. The earnings are at $1.98 a share. The estimate called for a profit of $2.20 a share. This is a miss, certainly on an earnings line, $1.98 a share versus an estimate of $2.20 a share. The revenue estimate is $26.83 billion. The revenue this morning, $26.80 billion. We are looking at the stock trade lower right now at JPM at $99.51 a share, down 1.5%. Of course, these numbers are just hitting the tape. Again, it's $1.98 on $26.80 billion in revenue. Joining us right now is Altium Wealth Portfolio Manager, Market Strategist Michael Lee to talk more about this. Michael, good to see you. Thanks very much for weighing in. Of course, I know numbers are just coming out. You had your expectations in place. What's your reaction here?
Well, encouraged to see that we don't have a big revenue miss like we did with Citigroup yesterday. So if the top line, you can't, the bottom line, there's all sorts of adjustments that can be managed for different reasons. You can't fake the top line, right? And so the top line with a very small miss, I think we're looking at only about $25 million worth of top line miss right here. So encouraging. We'll see what comes out. We'll see how sales and trading looks. I want to see how sales and trading comes out, and I also want to see how community banking does, because community banking is a kind of a better bellwether on the overall economy.
The $26.80 billion in revenue, that's managed revenue.
Yeah, well, you know, Citi had a much larger miss in the top line,
yes,
but was able to beat on the bottom line. So we'll see as the market digests this. Right now, not a huge move, 2%. You know, but what I think will affect this stock price going forward for the next year has far more to do with the shape of the yield curve. So if we get, you know, long rates sell off and short-term rates either come down a little bit or not move up as much as the long end, you know, that's what ultimately will move the stock price. So you know, I'm a little bit surprised at earnings coming in here based on the tenor and the tone of your interview last week with Jamie Dimon. He seemed to be a lot more positive than this sort of miss. So you know, we'll see as more.
He did. And this morning, Jamie Dimon, CEO of JPM, is saying that volatility and market move affected the company's earnings. He was much more positive on the backdrop. Certainly last week, I sat down exclusively with Jamie Dimon in an interview. He weighed in on this tight credit market as well. Of course, we know capital markets were under pressure in the fourth quarter. Watch. I'm glad you mentioned that, because there was no high-yield debt issuance in the month of December, and it's the first time that's happened in a decade. Yeah, is that an ominous sign? I remember during the financial crisis, which you lived through and you led with such great leadership, it was the debt markets that got us into trouble. Yeah,
but it was the deleveraging, the liquidation of debt markets, not the lack of issuance. So my view is that in December things slowed down, people got scared, issuers didn't want to issue, spreads gapped out. That'll probably change.
How long can the credit market stay this tight before you actually do see it as a worry sign?
For a while. I'm really not worried about it.
Mm-hmm. He's not worried about it. He knew that the markets were pressured in the fourth quarter. Michael, your reaction?
So when we talk about credit spreads, that's historically been a leading indicator of bad things to come, in that when credit spreads widen out, or in simple terms, how much it costs companies to borrow over and above the amount of the treasuries. When that leads the equity markets, that's not a good sign. However, what we got here was an increase in equity volatility, and that increase in equity volatility increased credit spreads. And what I mean by that, what is a credit spread? A credit spread is the difference between what it costs a company to borrow and the comparable treasury rate. Okay, that is the equivalent of the equity risk of that company. And so, as interest rates moved out dramatically last year, equity volatility almost doubled. As equity volatility almost doubled, the equity risk of that company increased, and so equities actually led spreads, which is not necessarily a worrisome sign. Just kind of, you know, corporate bonds coming in line with equities.
The CEO, just want to say that Jamie Dimon's also saying that we urge Washington leaders to strike a collaborative and constructive tone in 2019, Steve.
Yeah, right.
That's dancing around the party, isn't it?
We sent him a Valentine, too, coming up on Valentine's Day. But on the basic of business of banking, which is lending, do you see the rise of non-banks getting more and more, especially small business lending?
So if you look at commercial and industrial loans, you know, traditional, they're up 10% over the last year, and you also saw the growth of M2 up 5%. So while the Fed is raising interest rates, we're not seeing any sort of tightening. And yes, you are seeing this these sort of non-banks pop up over and over. But while the Fed is tightening, they're also loosening the macro-prudential. And it's one of the reasons why I think Jerome Powell is the right choice for the Fed chair, because he's a banker. He's a banker and attorney first, more than an economist. And I think the problem with the Fed does not come from raising interest rates or quantitative tightening. It's the over-regulation of JPMorgan, of Wells Fargo, of Bank of America that we got post-crisis, which is really one of the main drivers why we've had such an anemic recovery up until recently.
Yeah, and because the regulation rollback really didn't affect the large banks, Matt, right? I mean, it was more the smaller banks that really got the relief.
There was a right. For the large banks got very heavy regulator presences in the bank. I mean, Wells Fargo is a bit of a special case because of the problems they have there. They're still operating under tight Fed supervision. I want to go back to December. You've seen Citi affected. It looks like JPMorgan was affected by the volatility. You were talking about that. It's clear that, in terms of market volatility and impact on firms, was a meaningful event. But you also sound optimistic that it was a temporary event, that things are leveling out. So as you look at markets so far at the start of the year, are you feeling that's an event we're going to work through, or are you seeing more trouble ahead for markets and for banks?
So the problem with a lot of these trading departments in that you'd like to see in these types of volatility the big banks be able to profit. However, almost everybody is inherently long. So when you have a violent move to the downside, it tends not to translate through. And so it doesn't seem as if JPMorgan was able to profit significantly from it. We know Citigroup didn't. Yeah. So you could probably expect the same to come from some of the other investment banks, that this volatility was a negative.
I want to point out this is the last quarter that all these banks will benefit from the year-over-year comparisons because of the tax cuts. So it's a bit of a surprise that they miss on the bottom line like that. Mm-hmm.